Velo3D just dropped their Q2 2026 numbers, and I mean, the top line is an absolute monster. We are talking about a massive top line beat here.
Wow, massive. It really caught the street off guard.
Right. So JAF revenue came in at $20.7 million, specifically $20.664 million if you're looking at the raw filings. And to put that in perspective, consensus was bracing for barely 13.5 to 14.1 million.
Which means they crushed those estimates by, what, roughly 46 to 53%?
Exactly. It's a 52.3% year-over-year surge. But before you buy into this whole turnaround story, we really have to look at the bottom line, because the EPS is a completely mixed bag depending on your benchmark.
Yeah, the earnings per share definitely complicates the narrative.
It does. They reported a non-GAAP adjusted loss of 30 cents per share, so that actually missed the more optimistic 27-cent loss consensus.
Right, but it managed to beat that institutional 31-cent loss tier, so it really depends on who you ask.
Yeah, exactly. And meanwhile, the GAAP diluted EPS came in at a loss of 39 cents.
But the forward-looking stuff was aggressive. I mean, management raised full-year 2026 revenue guidance to a range of 65 to 75 million.
Up from 60 to 70 million, right?
Yeah. And they reaffirmed that target of hitting positive EBITDA in the second half of the year.
And as you'd expect with numbers that wildly divergent, the stock reaction was just highly volatile.
Oh, it was a roller coaster.
It really was. So it closed the regular August 11th session at $13.69. Then it surged over 19% in after hours to 16.09.
And then it hit that intraday high of 17.61 the next morning.
Right, before finally settling at 15.10 on just massive volume like 4.77 million shares.
Yeah, so a lot of hands changing there.
For sure. So for you listening, especially if you're a retail investor trying to parse these earnings, the immediate question is, whether this sudden momentum is a genuine operational turnaround or just a financial flash in the pan.
Right. Is it sustainable?
Exactly. So we are framing this deep dive as a tight analytical breakdown of how Velo3D actually achieved these numbers, and honestly, whether this narrative holds water.
Because a 52% revenue surge doesn't just happen by accident.
It doesn't. So to understand how they crushed top-line estimates, we need to move straight into the revenue composition.
Let's break it down.
Okay, so 3D printer and parts sales generated $19.0 million, which is up 57% year over year. And they brought in $1.5 million from support services.
And the forward-looking metrics look solid, too. New bookings hit 29 million, pushing the total backlog up to 31 million.
31 million. Okay, but I really want to look at the business model shift here.
Yeah, because this wasn't just about, moving more metal 3D printers off the warehouse floor. The growth was really driven by higher average selling prices, a better product mix, and this massive strategic pivot toward RPS.
Rapid Production Solutions.
Right, RPS. They are fundamentally trying to shift away from just being a hardware vendor.
Okay, let's unpack this. Because honestly, whenever a legacy hardware company claims they're pivoting to, like, services or solutions, my radar immediately goes off.
Sure, it sounds like corporate buzzwords.
It really does. I mean, are we just looking at a short-term spike because they managed to sell some really expensive, customized hardware units this quarter? Or is this a legitimate shift to a recurring revenue model, like, the old razor and blades model?
Right. Sell the razor cheap, make money on the blades.
Exactly. Is RPS actually the high-margin blade here, or are they just slapping a new label on their most expensive machines?
It's a fair skepticism, but the data actually suggests this is a real structural shift. Think of it less like selling a piece of hardware and more like becoming the Amazon Web Services of manufacturing.
Oh, interesting comparison.
Yeah, so before, Velo3D would try to sell a $2 million printer to an aerospace company, and then that company has to operate it, maintain it, figure out the logistics.
Right, which is a massive barrier to entry.
Huge capital expenditure. But with RPS, Velo3D is essentially renting out their own manufacturing capacity. The customer sends a digital CAD file, and Velo3D handles the printing at their own facilities, delivering the finished parts.
So you aren't buying the server, you're paying for the compute power.
Precisely. And RPS revenue grew at double digits this quarter. Management actually projects it's going to make up 25 to 30% of total revenue by the end of 2026.
That's a huge chunk.
It is. But the metric that really proves your razor and blades theory is the 83% repeat purchase rate.
Wow. 83%.
Yeah, it indicates incredibly sticky customer retention. Once they validate a part on an RPS contract, they don't leave. They embed Velo3D into their supply chain.
Okay, that sticky revenue is great, but And we talk about this all the time. Revenue growth is completely meaningless if it costs you a fortune to generate it.
Exactly. You can't lose money on every unit and make it up on volume.
Right. So let's shift from top-line sales to the bottom-line retention, specifically the margins. Because on the surface, Velo3D achieved this massive gross margin flip.
It was a big headline number.
They posted a positive GAAP gross margin of 21.5%, which is a stark turnaround from the negative 11.7% they recorded in Q2 of 2025.
Going from negative 11 to positive 21 is exactly the kind of inflection point that triggers algorithmic buying. It tells Wall Street the unit economics might actually be working.
But here's where it gets really interesting.
Yeah.
When I was digging into the filings, I pushed back hard on this margin victory
Yeah.
because it looked suspiciously like accounting gymnastics.
Ah, yes, the reclassification.
Right. They explicitly stated that they reclassified certain labor and overhead expenses. They took them out of cost of goods sold COGS and just pushed them down into operating expenses, or OPEX.
Yep.
So, sure, the gross margin looks infinitely better, but didn't they just artificially inflate that metric? Like, is there a legitimate operational reason to do this? Or is management just putting lipstick on a pig?
What's fascinating here is that there is actually a legitimate JAP reason for it, but your skepticism is totally validated. Under accounting rules, costs directly tied to making a product have to sit in COGS. But Velo3D is scaling up a massive new facility in Livermore. CFO Jim Suva argued that as staff transition to ramping up this new facility, they aren't directly producing current revenue-generating parts anymore.
Oh, I see.
So legally, those labor and overhead costs have to transition from manufacturing COGS to corporate operating expenses.
Okay, so they have a defensible accounting reason, but the reality for the investor is the cash is still leaving the building.
100%. Because of that move, JAP operating expenses surged 55% year over year to $15.5 million.
55%.
Yeah, so the gross profit line looked beautiful, but the actual operational loss barely budged. They still posted an $11.1 million operating loss.
And an $8.1 million adjusted EBITDA loss, right?
Exactly. It was an operational realignment for the Livermore facility, but investors have to realize the company remains structurally unprofitable right now. They just shifted the weight to a different line item.
Which means the only way out of this structural unprofitability is scale. If you're bleeding cash on operations, you have to produce enough volume to dwarf those fixed costs.
That's the only path forward.
And that naturally transitions us to management's commentary on demand and capacity.
Yeah.
Because CEO Aaron Geldai was very aggressive on the call about these surging demand vectors.
He was particularly focused on defense and space.
Right. He highlighted unmanned systems and munitions in the defense sector, which makes sense given global events. But the one that really caught my eye was the AI energy play.
Yeah, that was a surprising detail.
Right. Like, we all know AI data centers are creating this massive energy demand, and tech giants are looking for localized power. But Geldai mentioned this is driving direct orders for Velo3D's advanced gas turbine components.
It's a really brilliant second-order effect of the AI boom. To power these data centers efficiently, these localized microgrids need advanced gas turbines that run at incredibly high temperatures. And traditional metal casting just can't create the intricate internal cooling channels required to keep those turbine blades from melting. The geometry is just too complex.
But a 3D printer can do it.
Exactly. Velo3D prints the cooling channels directly into the solid metal, layer by layer.
Wow. But all of this surging demand defense, space, AI turbines, it points to a glaring bottleneck. They are in a strictly capacity-constrained environment.
Geldy literally said if he had 100 machines built today, he could deploy all of them immediately.
Right. The market wants it, but they just can't build machines fast enough.
So their solution is the new Livermore production campus, or Forge 1.
Right.
It's a 289,000 square foot facility. It's expected to triple their manufacturing capacity and start producing revenue-generating parts by Q4. CFO Jim Suva bluntly called this a capacity game.
A capacity game, which means scaling machine volume is the absolute only way to absorb their fixed costs. But expanding capacity like that requires massive amounts of capital.
Staggering amount.
Which transitions us seamlessly to the balance sheet, and honestly, the most glaring risks in the 10Q filing. On the surface, the recapitalization looks great. Cash and equivalents are up to $91.1 million from just $39 million at the end of 2025.
And they slashed outstanding debt by 70% down to just $8.2 million.
But we have to talk about how they got that cash, because it was heavily painfully dilutive to existing retail investors.
Yeah, the share count exploded.
Outstanding shares surged 30.6% in just 6 months. They did a $50 million direct offering at $14 a share and then raised another $59.4 million via an ATM and at-the-market program.
Right, which just bleeds new shares into the open retail market every day.
Exactly, it's the cost of cash. But this raises an important question because even with that $91 million, they are burning through it fast.
This is the heavy analytical hammer here. Despite that huge cash infusion, Velo3D burned $39.5 million in operating cash flow in just the first half of the year.
That is a staggering burn rate.
It is, and it's why management explicitly reiterated their going concern warning.
Which is management legally telling investors there's substantial doubt they can survive the next 12 months without raising even more money.
And to make matters worse, there's a massive off-balance sheet commitment hiding in the footnotes.
Oh, right, the lease for Livermore.
Yes. That facility comes with a 124-month lease requiring $57.9 million in minimum base rent.
Almost $60 million. But why wasn't that on the June 30th balance sheet?
Because the lease technically commenced on July 1st.
Literally one day after the quarter ended.
One day. So it legally bypassed the Q2 balance sheet, but it represents a massive fixed cost hitting them right now in Q3.
Wow. So they are in this intense tug of war, which perfectly explains the deep divide among Wall Street analysts right now.
Yeah, the analyst community is completely split.
You have the bulls, like Needham, maintaining a $33 target. They are laser-focused on the demand, the 52% growth, the RPS pivot.
But then the bears are pointing to the 30% dilution and that going concern risk. Weiss Ratings just upgraded them, but only to a sell or a D-.
Right, so before we wrap up, if we connect this to the bigger picture, if they actually survive this cash crunch, what is the end game here?
Well, if you read between the lines on the earnings call, the real long-term value of Velo3D might not be hardware at all.
Really?
Yeah. Management hinted at evolving into a connected digital manufacturing platform.
Okay, what does that actually mean?
It means using real-time print data and AI across their entire global fleet of printers. They are using that data to optimize material science.
So if they pull this off, they aren't just a printer company.
No, they would be creating a highly lucrative, durable software revenue stream. If they survive the capital crunch, they could essentially become a manufacturing data monopoly.
A manufacturing data monopoly. That is definitely something to mull over. Well, if you want to stay ahead of the markets, make sure to follow the show for our daily earnings coverage.